Do the losses in the market mean the money disappeared? The money you lost is in someone else's pocket now. Like how Einstein said energy cannot be created or destroyed, it just changes forms. The same thing is happening with your money. If the money you lost is in the hands of someone else, it wasn't truly lost. To figure out what's happening, you need to learn how money is transferred. Imagine you sit down at a poker table in Las Vegas. Now, poker, let's say it isn't your passion, but you like to play it every now and again, all right? And while you're sitting down, you hit a streak. You keep winning. It feels great. Your confidence grows. So you keep playing and keep betting a little bit more and then a little bit more, and you watch. That pile has grown. Your money has grown. Eventually, though, your luck changes. On one big hand, you lose. But hey, it's just one hand. So you keep going. But now you hit an unlucky streak and start losing. You end the night with less money than you started. As you meet up with friends and family, you tell them of your losses. But were they losses? What if there's more to the story? What if you find out later that you're playing against a World Series of poker winner, but you just didn't know it? Now, they may have let you gain confidence by bluffing and then waited for you to have a peak emotion of greed where you thought there was no limit and then you played the hand. This isn't much different than the stock market. A big reason we have seen dramatic downturns actually has to do with hedge funds. I'll explain the basics of a hedge fund and compare them to a mutual fund that most retirement plans are kind of holding on to. I'll also break down the risks you face and where most of the return happens in the market. There's so much misinformation with the market and expectations that continue to let people down, put them at risk, and impact their lifestyle and stress. All right, let me break it down so you can take back control of your money and question the advice of weather the storm. You're in it for the long haul, or that the market's on sale, or that it's time to buy. Well, is it? Are you sure? How do you know? Here are the three pieces to how money's transferred. One, there are major limitations to mutual funds. Now, there are index funds, right? Those are really low costs and they're not managed. There's also managed funds, which have usually a higher fee associated with them, or even ETFs or exchange traded funds, right? Those are, once again, very inexpensive as well. Now, in turbulent times like these, they all face major risk that will create losses for the average investor. But once again, those aren't necessarily losses. Think of those more as transfers. Growth funds have to stay in growth, even if it doesn't make sense. They're limited to fund objectives. Those fund objectives spell out how they have to invest. Now, even if the fund manager knows differently and thinks it's something that they should move to, like cash or something non-growth related, well, they can't. If they do, they get in trouble. In the 90s, Jeffrey Vinnick moved a bunch of the Fidelity Magellan Fund out of growth stocks because he thought there was going to be a dip in 1998, which there was in October. When he moved it, well, he was fired. Fidelity was sued, and there were problems. The other problem that mutual funds have is there's fees, and you're paying those fees whether you make money or not. So because they're kind of subject to having to stay in growth, even when that's not the right time, it limits their ability to manage risk. See, the overall stock market averages are skewed, and it comes down to hedge funds and options trading. Now, whether that's options trading as derivatives or what are called calls and puts and things like that, we'll talk more about what that means. See, a hedge fund, it doesn't have to rely on the stock market going up in order to make money, but mutual funds typically do. Now, to get in a hedge fund, you've got to typically be an accredited investor, which means you have a certain amount of income, like $1 million or higher every year, or a certain net worth. And there's usually a minimum investment. A lot of the minimum investments are $1 million. Some of these like lower tier hedge funds might be 100,000. But look, a lot of the lower tier hedge funds lose a ton of money because they're not really managed by the highest talent. So hedge funds typically aren't as liquid as a mutual fund, meaning that you might have restrictions and you can't just sell at any time. They're also much more expensive than mutual funds, definitely much more expensive than index funds or robo funds that we hear about, where we got, the kind of the robot managed funds and algorithms and stuff. But look, a lot of hedge funds don't actually outperform the market, but the few that do, especially during times like these, end up with a lot of the retirement plan money that is so-called lost. Going back to options, derivatives, and you've probably heard of futures, right? Because you see like what's happening in the futures market starts to let us know what might happen when the market opens. So let's say that an option could be a call. That means someone thinks the market's going to go up, and they might buy on margin, or they might say, okay, if it goes up, you're going to get an even bigger return. Or a put is, hey, we think it's going to go down. So you might even hear terms like it's something short or long. Short means selling short is, hey, we've borrowed these funds, and when the market goes down, we get the gains as a hedge fund, and everybody else takes the losses because they were long. Short means we think it's going down soon. Long means we think it's going to keep going up. So if you're looking for stocks that are likely to decline, well, that's when you'd want to short sell it, right? You borrow those shares from someone else who owns them. You sell the shares and then make money by later replacing the borrowed shares with others bought at a much lower price. Part of the major downturn was a lot of these hedge funds selling short or selling positions, and they have so much money that it actually moves the market. Now, options are kind of win-lose. One person bets it goes up, the other one bets it goes down. One person ends up with the money, the other person loses the money. Or if the market goes down and you're like, wait, but I bought when it was worth more, and then you sell, whoever you bought from is the one that made the money, and you're the one that took the loss. Look, George Soros is a pretty legendary hedge fund investor, and he got annual returns exceeding 30% for more than a decade, while the market was only going up 6 to 8% during that time. That means the average investor isn't getting what this multi-billion-dollar fund is getting. He also shut down a fund in the year 2000 when things went south in the market. Once again, there's, win big, lose big. So let's go back to that analogy. These hedge fund managers are the best in the world. They're the World Series of Poker champions. They're making different bets than the people that are just in it for the long haul and dollar cost averaging and putting their money in a mutual fund for the next 30 years. Plenty of managers, there's plenty of them, but only a few that are amazing and that get the majority of the large returns in the market. See, they have enough money to potentially move or impact the markets like I mentioned. When they sell positions, you can see the market go up or down while their accounts are changing. They're not limited to making money only during growth times. All right, the second thing here is there's average returns versus actual returns. One thing that will not be calculated for you moving forward with your retirement funds is the impact of companies that will go out of business. When that company goes out of business and you have money in today, whatever percentage of your mutual fund owns that business is kind of lost moving forward. But that stock that goes out of business won't be calculated moving forward. Instead, it'll be replaced with a new stock that may have growth that you don't actually get, right? Because you only bought that share through your gains or through new deposits. The money that you lost was lost. The company that went bankrupt is now gone. So that makes these average returns misleading. You can have an average return of 0%, but still end up with less money than you began with. Let's look at the plus and minus there. Okay, first off, because fees might not be calculated in your average, you can have losses even at a 0% gain because you paid those fees. Volatility impacts you. How does volatility impact you? Well, let's look at average versus actual math. Imagine I'm in a shower, but there's a shower head on my left and my right. I turn one freezing cold, the other scalding hot. Those are two different temperatures, but on average, it's a lukewarm temperature. But in reality, I'm miserable as hell. So if I have $10,000 and it loses 10%, I'm now down to $9,000. If my $9,000 now gets 10%, I'm only back to $9,900 before the fees are paid. So this is part of the problem when they're talking about the market's back up 10%, but 10% of what? If the market's down 20%, getting 20% back doesn't get us back to square one. And those companies that go out of business permanently further exaggerate the average return versus the actual return. Let's also mention the mental impact of money going up or down, or impacting your personal stress, or creating all this additional concern. And it becomes a conversational distraction too, where people are now going, oh man, I've lost all this money. So this kind of infuriates me because people feel, oh yeah, the market's averaged X%, but averages and actual returns are two separate things. Now, if you want to learn more about this, text 44222, type in the subject wealthier to get several resources to navigate the financial world without relying on the stock market. 3, is the stock market even the good place that people think it is to put your trust in money? In the 90s, I think it was. The stock market had an unbelievable ride of great returns. And in 1999, there were over 400 companies that had an initial public offering, right? An IPO. So they went public and you can now buy them on an exchange. People really believed these double-digit market returns were the new norm. When we look at how things have progressed since then, we see a very different trend. Fewer and fewer companies have gone public, with only 190 companies having their IPOs in 2018. That's a pretty big difference. The circumstances and outcomes of those companies that did go public since 1999, well, nearly half of them are no longer available for purchase because they either closed their doors, were bought out by another bigger company, or they went bankrupt. There's bankruptcy, there's scandal, there's constantly technological upheaval in the market today, right? We're seeing all this disruption. It's even more important now to avoid the speculative behavior of gambling in the stock market if we stay with this poker analogy. Do you want to go up against hedge fund managers? You know, even big name companies who were staples in the community just 10 years ago are vanishing. Companies like Sears, Lehman Brothers, Dell Computers, Avon Products, Radio Shack, these were the companies with high stock prices. These companies were considered titans of industry that are no longer in existence. Things are changing, and these changes aren't going away. The internet has brought faster public access to things people want and need, removing the need for them to go to most box stores altogether. You know, we've got artificial intelligence. We've got all this kind of stuff. And as it stands today, the average return on the stock market for the last 20 years is around 6%. And as you know, that number is just going to go down and reduce with the happenings here in 2020. The most interesting part of that 6% figure, 84% of all issued stocks belong to only 10% of the wealthiest households in the U.S. Enter hedge funds. The average return on the stock market is actually determined based upon the number of stocks owned divided by the value those stocks hold. So if the overwhelming majority of all stocks belong to those wealthiest families, the biggest hedge funds in the world, or the return came with shorting those stocks, the overwhelming majority of that 6% appreciation is not in the hands of your retirement plan. These issues associated with the stock market don't stop there. Think about the advances in computing technology happening every day. Some of those advances, such as the artificial intelligence I mentioned, have the potential to disrupt thousands of public companies. Obsolescence is on the way, and investing in obsolete platforms designed like poker against the pros is a gamble I wouldn't make. The stock market isn't a safe way to invest your money, as marketing would promote. Since 1999, there's been a 31% decrease in companies having an IPO, with nearly half of the companies available in the stock market vanishing with mergers, bankruptcies, and scandals, when the possible reward of investing in the stock market is just 6% before the declines we're seeing right now, with a guarantee that most of that 6% rests with just 10% of the wealthiest families in the United States. It becomes clear the stock market is costing you far more than you'll ever see from it. Do the losses in the market mean the money disappeared? No. The money you lost is in someone else's pocket now. Einstein said it clearly, right? Energy cannot be created or destroyed. It just changed forms. The same thing happened with your money. Stop gambling. Stop creating unnecessary stress. And don't rely on a model that isn't designed to work for you. It's time to protect your money. Take control of your finances and learn the lessons from this downturn. Now, you have the knowledge to transform your thoughts into profits, take a different course of action, and build a life you love. If you're looking for more on this topic, check out my video on how to save yourself from the market freefall. You'll learn the actual returns during a volatile period here in 2020. Real numbers that demonstrate the ideas we shared here with the software to back it. I'll see you there.